Cool, folks. Let's start. It's 7:04. First of all, I really want to thank all the attendees who have showed up today. We understand that it's quite late in the evening. The thought process was that we make it a bit simpler for you to join post work. But nonetheless, I'm super sure that you would be a little tired. We're cognizant of that and we'll try to quickly cover up the presentation. Before that, I would like to highlight what we are trying to do today, what the agenda for today's presentation is. Right? So there are going to be three things today that we'll be covering. Number one, we will be covering a little bit about what the bond market is, why are bonds important, what are bonds, and what are the risks associated by investing in that asset class. Then I will hand over the stage to Azhar, who's my colleague. He will take us through the OBPP guidelines that came up by SEBI a couple of years back, and will also take us through Jiraaf, who we are, and what are our offerings. Lastly, during the whole presentation, we'll try to cover some of the frequently asked questions. Right? This is the most important part of our presentation today, because the thought process was that we keep hearing a lot of questions from our customers. Right? Either they are current customers or they're new to the bond or fixed income investing. So we said, hey, why don't we address this problem by doing a webinar on the same? What I request for all the attendees is to please use the chat window in Zoom to put down all your questions. And at the end of the presentation, we'll take them. The idea is to finish the presentation in 20 to 25 minutes. So let's take a step back, right? Let's understand what are bonds. So we have here a very simple presentation of what bond is, right? So on one hand, which is your right hand side, you have counterparties, which are corporates or governments or startups or MSMEs. They can raise money in two forms. One is by diluting equity, and the other is through debt. So when they raise money through debt, they give they issue a bond to the investor. Investor then invests in this bond by providing capital and getting a bond as a security. And in return, what the investor gets is periodic interest and principal payment over a definite period. I think the most important takeaway on this slide is to look at the bottommost part of the slide, which says it's periodic interest, principal payment, and over a definite tenor. So I think that is what differentiates fixed income or bonds as an asset class vis-a-vis other investment asset classes. Moving on to the next slide. Now we are a little perplexed, right? In the last few years post COVID, we have seen a massive rise in terms of the financial products that are being offered, right? On your left hand side, you see the chart where on the y axis we have marked out yield or return of investment, and on the x axis we have marked down risk. So you have securities like FD savings account, including some securities like structured credit, invoice discounting, all the way to angel investing crypto, which are extremely risky but have a potential to earn high return. So the question that you might have as an investor is, boss, how do I make sense of the whole investment landscape and how do I go about investing? So on the right hand side, what we have written is talking about what we have seen the journey of an investor, how does it evolve? So when an investor starts investing in the early days, they start investing with traditional asset classes. Think about asset classes like FDs, national saving schemes, small saving schemes, and also they take exposure in gold. If they have a lot of capital, then they also invest in real estate. So this is phase one of their investment. Phase two of their investment is then they start getting into more risky products. Think about equity. And they also start venturing out into different kinds of fixed income products. Why do we say that we need to have exposure in multiple products? I think the answer to that is diversification, right? So, as they say, never have all your eggs in one basket. So, that's how we have understood the investment journey. Moving on to the next slide. Let's also understand that what are the key risks in bonds. And here I would like to talk about the first two risks. Number one risk is there is a default risk. What I mean by that is that the counterparty, which I had in the first slide, discussed about the government, corporates, MSMEs, right? If they fail to make timely payments and interest or principal repayments, that's when the bond defaults. So that's risk number one. The second risk that I want to talk about is liquidity risk. It's difficult to liquidate your bond investment security. What I mean by that is, if you have invested in a bond today, and this is a problem of today, uh, hopefully in the following years to come, the liquidity risk should come down. But today, what the problem is that if you have invested in a bond for 15 months and after 7 months you want to sell off this bond, it will be very difficult for you to sell it off in secondary market. Moving on to the next slide, let's understand, let's again go back 50,000 feet, try to understand what the fixed income market is. So what we have done here is very carefully showcased the global market, global equity market cap, which is in yellow, and the Indian equity market cap, which is in orange. So we are comparing two asset classes here. One is equity on the left hand side, and the right hand side, we are comparing fixed income, India versus global. What we see is that globally, your fixed income market size is much larger than your equity portfolio market size, right? However, in India, this ratio is opposite, and it's significantly more opposite, right? Which is your Indian equity market is 4.4 trillion, while your Indian fixed income market is valued at 2.5 uh, trillion. Let's understand why is this the case, right? So the biggest reason why we understand is this asset class so far has only been there for the ultra wealthy, the UHNIs, family offices, and large institutions like insurance companies and endowment funds. Often, this asset class has remained away from the retail investors, investors like you and me. This is where we see a massive, massive opportunity by democratizing the whole fixed income. Moving on to the next slide. Like I already talked about, that there is today, why is under penetration the case? Is because not a lot of people know about fixed income securities. Recently, in the last 5 to 10 years, we have seen a massive boom in the equity markets, right? Why did that happen? Is because it became the talk of the town. Anyone you're talking to, whether it's in the office canteen, whether you're meeting your friends for dinner or drinks, or even if you are maybe talking to your partner at home, you're often talking about equity markets. So in the last 4 or 5 years, there's been a massive explosion in terms of awareness, which has then resulted in investments in the equity market. Similarly, as the retail investors understand this asset class, which has often been under the shadows, they will invest and the market size will increase, and the investment will happen where players like us will create digital platforms to make the investment safe and secure. Moving on to the next slide. Let's understand why should you invest in fixed income. Right now we have understood what are bonds, what is the market, how does it compare internationally and in India, what are the risks. But boss, why are you asking me to invest in fixed income is the question that I'm assuming you would have right now. So the first reason that we believe is that these are steady and predictable returns which are non-market linked, right? So think like you're investing for a specific goal, whether you want to make an international travel, you want to buy a car, you want to buy a house, you want to go get that favorite designer bag that you have been eyeing of Louis Vuitton or whatever, right? With a fixed income, you can invest by doing a by setting up a goal-based investments framework. So that's number one. Number two, what's very interesting is that we have seen investors using it to pay off their recurring expenses. So think about your EMIs, your credit card bills, your household expenses, right? What the use case here is, since you are getting stable and predictable returns, you can offset this against your stable and predictable expenses. That's the idea. Moving on to the next slide. Let's understand I already spoke about equity, right? What is the difference between fixed income and equity? Because this is a question we get asked a lot. So, number one thing is listed equities are very, very volatile, right? They are influenced by what's happening globally, what's happening in the Indian micro market. They are influenced by macroeconomics, they're influenced by that specific company, or they're influenced by a lot of different things. And hence, it's very difficult for one to underwrite predictable returns, right? Vis-a-vis fixed income. Like I mentioned earlier, the returns on the fixed income security are not linked to the market forces. So that's benefit number one. Number two, owing to the very high volatility of equity markets, what we suggest is that listed equity is a very good asset class from an investment standpoint to invest for a very long term, because that's when you withstand the volatility and risk in short term correction. Like we are seeing maybe today in the last quarter, quarter and a half, we are seeing that the equity market is very volatile, right? Vis-a-vis fixed income, what we see is that these are a very ideal asset class for shorter to medium term horizon, where you are prioritizing capital preservation. And lastly, in terms of the returns, right? Listed equity in terms of the most popular benchmarks like the Nifty 50 or the BSE Sensex, the last 15 years CAGR has been in the range of 15 to 16%. When you look at rolling returns, maybe in the last 15, 20 years, you say that spread between 12 to 15 years, 3-year rolling returns or 5-year rolling returns. However, in fixed income, by investing in bonds, you can earn anywhere from 10, 11% to 15, 16%. So these are not directly comparable to equity, but they are almost there, is the point we want to make. I think the most important learning for us being in the financial services ecosystem is that when we look at all the developed markets, think about markets like Japan, USA, Europe, what we see is that as an investor matures, they start allocating their wealth across different asset classes for because each asset class has a nuanced risk return characteristic. And number two, each asset class has a different value to add to your portfolio. What we are again saying is, what I want to clarify is we are not saying don't invest in equity markets. But what we are saying is think about investing in fixed income as well. Moving on to the next slide, which is that today the timing is absolutely right, right? The rate hikes, interest rate hikes that we saw post COVID, right? First, they brought down the interest rates, the central banks globally, to inject liquidity in the economy in the local countries. Post that, they realized that there is maybe a little bit of inflation and that's difficult to come to control. They started with aggressive rate hikes. And because of that, the bond yields are determined by the interest rates that, to a large extent, they're determined by the interest rates of the central bank. So today we see some of the highest interest rates in the last couple of decades. And that's why we feel that today the returns that you're earning on fixed income securities, today the timing is right for you to consider investing in fixed income securities. Now that we have understood what a bond is, the bond market are, what are the risk of investing in it, and most importantly, why should I look at investing in this? I would now like to hand it over to my colleague Azhar, who would take you through the OBPP regulation that SEBI came up with a couple of years back, and post that explain you about who we are as Jiraaf and what our offerings are. Thank you.
So hi everyone, good evening. Thanks for joining to this another Giraffe Connect episode of the bonds investments and everything. So yeah, moving to next, I just want to talk about what is OBPP. See, this is one of the things that I want to tell you, that a lot of people, this OBPP, what is this OB, all this. So OBPP is nothing but it is online bond platform provider. Okay, so basically what has happened is that the SEBI came up with a regulation before 2 years where they wanted to all these platform which started for the last 2 3 years providing all these fixed income securities, they were not under SEBI purview. So in order to get everybody under same umbrella, so SEBI came up with the OBPP guidelines. So what is exactly OBPP is that it is nothing but the platform who want to run as an OBPP, they have to register as a broker in a debt segment with the exchange, and subsequently they have to obtain the license from SEBI as an OBPP platform. Okay, so exactly moving to next, Madhu. So when OBPP regulation came into effect, so before answering this question, I want to tell you a little bit of background to. If you really see the bond as an asset class, it was dominated by a lot of big institutions. Call it mutual funds, call it PMS houses, family houses, ultra HNI investors, and all that. So retail participation was very less prior to, I would say, in before 2015 or maybe before 2010. There were a lot of because of a lot of limitation. There was no participation from the retail investor side. So what exactly happened is that back then in 2010, I remember when government first came in into tax-free bonds, for a non-institutional space for the retail investors, and after that, during the time of COVID, as highlighted by Gautam also during the discussion, we saw a surge in the fintech platforms. The platform providing the different financial products for investment per se to the retail investors. So there we saw a rise in a lot of participation into the fixed income securities. So that was a time when we saw people even participating into fixed income products. And after by the end of 2022, 2023, the participation by retail investors is really increased because of all these different platforms, different products like bonds, government securities, fixing even FDs. Nowadays you can see that you can buy FD products from this kind of a platform. So because of all this, because this rising market and also also the maximum participation by retail investors, SEBI came up with these regulations. In the month of November 2022, SEBI came up with the online bond platform regulations where SEBI really want to address everything about retail investor, for talking about what kind of information should be available on this kind of a platform, how customer can do his KYC, how customer can invest, and everything. SEBI wanted to under guidelines. So that is the reason why this regulation started during the November 2022. So moving to next. So yeah, as highlighted that into November 2022, this regulation framework came into picture. And if you ask me what was the need for this, need for OBP regulation. So basically what happened is that if you can see in the next slide, as I said that there was a rapid growth in terms of the participation by retail investors, and also a lot of people like there was no proper information because a lot of platforms were selling a lot of different kind of securities, call it listed bonds, call it unlisted bonds, call it a different kind of the products and everything. So that is where, in order to have a transparency, in order to have all the minimum information available on the platform, so that because of this, SEBI thought to come up with these regulations that will really help investors to make an informed decisions and then invest to it. So you might be wondering that what are the benefits. So see, this is one of the questions I get to hear from customers. They say that, hey, what is the benefit exactly investing via OBPP platforms? So very big benefit, no doubt at all. They are a SEBI regulated platform. So this is where one thing you like to see that, okay, yeah, hey, but are you guys are regulated? Because this is one of the seeing the kind of the frauds and a lot of things which are happening right now in this financial domain, and so a lot of the tech websites, unsecured websites. This is very important for our customers to see whether that platform is a SEBI regulated. So this is giving one of the comfort to customers to say that, hey, yeah, this platform is under SEBI purview. So I don't need to worry a lot about the entire transactions and function happening to this platform. So this is one of the very big benefit being a SEBI regulated platform. Second is definitely transparency, because of the guidelines what SEBI has said, what kind of the information it has to be there, how it should be flowed, how should be the KYC should be done. Everything, it is very transparent. So as a customers, you can see, you can read everything, what there before making any investment decisions or any further decision about your investments. And also it is like you don't need to earlier, if you know that earlier when you wanted to invest in bonds, a lot of time this transaction would happen over the counter. So there you had to transfer via NEFT or via RTGS, or a lot of in this way the payment would happen. But because of all these OBP regulations and the payment option now, you can easily invest by using your UPI and net banking options, because all this transaction goes through a secured route of, call it as RFQ. It is a request for quote kind of a mechanism that has been set up with the NSE exchanges, where whatever money you transfer, it goes to the exchange. It doesn't go to Jira. It doesn't go to the any platform. Directly, the money which you are investing, the money which you are paying for getting those bonds, it directly the money is sent to the exchanges, and from there your transaction is settled. And another important reason is that that transaction is settled very fast. For example, prior to this, if you invest in bond, it would take 5 to 6 working days for you to get the units in your demat account. Okay. Now, because of all these regular, all these RFQ and all this mechanism, now if you invest today, in the next 24 hours, in the next 24 hours, you get the units credited in your demat account. So this is as simple as this. Okay. And obviously these are the minimum disclosures. So it has happened that before this regulation, one platform, if you go to one platform, that platform is showing some 3 4 details. Then if you go to other platform, that platform is showing 5 6 details. If you go to third platform, that platform is showing only 1 to 2 details. So there were no standard guidelines that are what should be the minimum disclosure of those fixed income assets on the platform. And because of this regulation now, you can see that minimum disclosure is really required for all the platforms. They have to disclose all those minimum disclosures as prescribed by the SEBI in the regulation. Okay. And definitely this is one of the important pain part. If you are a customer, if you invest in any bond, if something happens after that, so if you're not happy, if you want to raise a complaint, where you will go? So there was no proper grievance redressal mechanism. So that is also one of the part of these regulations of OBPP, where you have to set up the proper grievance and redressal mechanism to sort out all the complaints of the customers within the given timeline as prescribed in the regulations. So this is where, so as a retail investor, you have to see this is a very big opportunity, because now there is somebody who's going to watch for you, somebody who's going to work on behalf of you, and someone who's going to really protect your interest if something goes wrong about your investment into this. Okay. An important part is this aftermarket orders. So aftermarket orders is like, it is as simple as that. Let's say if you don't get a time during market hours, obviously a lot of people, you are professionals, so you're busy till 6 6:30, or traveling, anything. So you can sit back and relax in the weekends. You can even explore the opportunities, and if you really like any investment opportunity, you can simply invest in that after market hours also. So that setup is also there. So all these OBP regulations call it for all different reasons, even for the platforms or from the investor side. It is a win-win situation, and I would say this is perhaps one of the very big watershed moment for all these fixed income platforms, and also increasing the confidence of retail investors to participate via these platforms. Yeah. So moving to next. So just want to tell you all the viewers that if you have any questions, there is a question and answer box there. You can write, if you have any further question about this, please feel free to write it. We will try to cover as much as possible. Okay. So that is something I would say we sets apart Jiraaf as a platform. So I'm not sure about if this kind of the help or assistance or transparency people get in any other platform. I'm not sure about it, but this is what we do at Jiraaf, and that's what we are proud of delivering this promise right now with customers out there.
I think that concludes our presentation today. Uh, Thank you again for all the attendees that joined us, were patient enough to hear us out, answer your questions. We had a lot of fun doing this engaging conversation. Further, if you have still any questions, please feel free to reach out to our team. We'll be more than happy to take up your questions, help you kickstart your bond investing journey. Thanks a lot.
Yeah, thank you all.